Finally, we come to our IT favorite IT company,
giant.
right?
Yeah.
I'm sure many of our students are familiar with this
Right,
company.
right.
Tata Consultancy Services,
Yeah.
right? Now, I just thought I'll put a slide which says where TCS stands, and we'll, of course, when we discuss industry, we'll spend more time on this.
Yes.
But worldwide, the TCS market share, they say is 1.6. Actually, when I show you the other slide,
Okay.
it's a little bit more. This is what this
Dart.
Dart is saying.
Yeah.
But I think it's like 3%.
Okay.
Or between 2 and 3%. Depends on how you count the total. They have counted $1.3 trillion as the size of the industry.
Okay.
Most people estimate about $700 billion actually.
Oh, okay.
So it depends on what you include, what you don't include. If you include products, you'll get 1.3 trillion. If you don't include, you'll get. So if you take pure services, it's like 3%. So what that means is that TCS, though it's a $22 billion company, represents only between 2 and 3% of the world market.
Global market.
So a huge headroom for growth.
Okay.
Right? Huge headroom for growth.
Yeah. And it's quite promising because from 10-year period from 11 to 21, we see that the market share has doubled, no?
It's keeping on increasing.
Fantastic.
In fact, I have some charts later on.
Okay.
It's keeping on increasing.
Yeah. One decade we see that it has really.
India has become more and more and more, right?
Yeah.
We've been growing, the industry has been growing 20%.
Okay.
Right?
Yeah.
So we have captured market share. So we have displaced basically the incumbents
Yeah.
in IT.
Yeah.
So in terms of competitive position also, TCS does much better than industry average. So in many factors.
Okay.
Like for example, customer sat or delivery quality, how good they are on cloud. These are some of the vectors which for growth.
Okay.
Are you good in cloud? Are you, AI and machine learning?
Okay.
These kind of things.
Yeah.
Account management is much better.
Oh, yes.
Productivity is better.
Yeah.
And so on.
Innovation.
So, typically, you will see the leader in each segment. They're a leader for a reason. The reason because if you take any of these kind of parameters, they will show better numbers than others.
Okay.
Right. So, which also means basically if a company is a leader and it is much more favorably positioned on these kind of parameters than the other companies, then their market share will only increase.
Yes.
And that basically means that smaller companies will eventually have problems. So, the only way for smaller company to gain market share against the leaders is by innovation.
Yeah.
No other way.
Yeah. Right? But here again, TCS innovation is way above.
I mean, though they say it,
Yeah.
So something else, basically some line of business which TCS is not doing maybe.
They have to get
in from there.
Yeah.
So this is the way in which most IT companies try to define their business vertical by vertical.
Okay.
So BFSI is banking and financial services.
Okay.
Communication and media, retail, right? Manufacturing, technology and services, life sciences, and regional means Indian market, for example, and so on. So government jobs and so on.
Yeah. So the way to interpret this, GV, 32% of TCS revenue comes from BFSI.
Right.
Is that the
in fact, actually for most IT companies. So historically, BFSI has always been the one that has invested most in IT.
Okay.
Financial services, primarily because innovation financial services can come about only by the use of IT. There's no other way to do innovation.
Yeah.
So they have, this is in fact 32% is lower than what it historically has been for TCS and many other industries.
Okay.
So it has been higher. It was 40% or something.
So banking, financial services, and insurance also. One small doubt here, GB, is that where does the government's use? Do they have a large government portfolio into?
They have a government portfolio. In fact, Infosys also has a government portfolio.
Okay, but that is
it's shown inside this regional market.
Others. Okay, because
it's not a big chunk.
I see. Because when I go to renew my passport, the passport seva kendra thing is TCS. So TCS.
In fact, TCS has some other things like ION and so on.
What testing agencies.
This is what we use.
Okay, so maybe life sciences and healthcare might see an increase now after the COVID. There is a possibility.
IT spending. So there is a possibility for that for people who do work in logistics, operations, and so on.
Okay,
but IT spending, we don't know whether it has increased or not.
Okay. Telemedicine.
So some, So there are niche areas like this. But if you look at overall, so in IT industry, you tend to track IT spending of the top 500 companies, Fortune 500. As what happens in Fortune 500 will generally be indication of how IT. So if you want to say how IT industry is going to grow next year, you look at how the Fortune 500. You do a survey of the Fortune 500 companies and ask them how much are you going to spend on IT next year. From that you make an idea.
So these agencies like Gartner and all produces those kind of.
They produce this report.
Okay. So that's a good source of data for students if they want to.
Very good source.
Okay. Yeah.
So geography-wise also you can see
Oh
some
yes,
trends. Yeah.
yes. So North America is the
By and large, the most, say 50% of the mix is North America, which is typical. In fact,
okay. Yeah.
many other companies is even higher than this, maybe
I see.
70% also.
I see. Very interesting to note that UK wants to be separate from continental Europe. Yeah,
Now,
is it the Brexit thing that is? Yeah.
Even otherwise,
Yeah. And domestic absorption of IT is quite low,
very low.
5%.
it's only 5% of TCS business.
Yeah.
But TCS as a percentage of IT in India is quite high.
Okay.
That is because Indian IT government or whatever, the IT spend in India is per capita is, as in everything else,
Less.
is very low. Yeah,
Okay.
it's extremely low.
Okay.
We have not automated that much. We have to do a lot more automation.
Okay.
I guess we tend to be labor. We have a lot of labor.
Yeah. Yeah.
Many more people entering the labor force also.
Yeah.
So the need for automation is
Yeah.
not felt.
And a percentage contribution to incremental revenue, we find continental Europe actually contributing quite a bit. Whereas in other areas, there is a decline.
Yeah.
Asia Pacific, there is an increase. So,
Yeah.
yeah.
It's a kind of an anomaly. I'm not sure whether this is something. Okay.
Okay.
It may be one order that.
Yeah. Yeah.
TCS gets not okay. They get because the Tatas has assets in Europe,
Right.
so they get business from
Yeah,
those assets.
yeah.
So
there's a cost of services. Yeah. And
how it broken up? So you can see salaries is the predominantly the biggest. 43.8% of sales is just salary.
okay.
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 And then there is subcontractors. This is a big thing for TCS. And as a strategy, many Indian companies, big Indian companies are starting to use subcontracting more and more. Make, buy, you said, right? Make versus buy.
Okay.
So rather than make, which is this 43.8, they're buying.
They're buying the services. Okay.
And for specialized skills specifically, it looks very good to use subcontractors.
Okay.
than to build it in-house.
So I hire a smaller firm and then I'll
use contractors. I'll ask people.
Yeah.
I'll have full-time engineer.
Okay.
FT, whatever. I get people from their contractors to
Right.
work with my customers.
Okay.
All the others are very small.
Yeah. So this is a very interesting kind of a cost breakup compared to a manufacturing firm.
Yeah.
Because here in the manufacturing firm, what we find is that fixed assets and capital investment, land, machinery, buildings, all are becoming major.
Yeah.
Here salaries are becoming the
Very high.
major kind of a thing.
So in textiles, you have little bit of salaries.
Yeah.
Material cost is there, but salaries have started to become prominent.
Yeah.
Here it is the component. There's nothing else.
Ultratech we saw
Ultratech has got
huge
very-
upfront investments,
Yeah.
and here it is salaries that is, and very interesting to note that the travel thing has also come down quite a bit.
Because of
0.5
with the COVID,
percentage of the sales.
Yeah.
Okay.
So from 22,910 crores, only 8,000.
It has come
Especially
down.
foreign travel is very expensive.
It's-
So generally it tends to be a very big bill.
Right.
Airlines stopped working. Everything
Yeah.
stopped working. Right? You
Yeah.
could travel.
Yeah. I think contrasting it with the manufacturing firms gives us a very interesting kind of a picture.
Right?
Yeah.
So, I think we saw this already. Let's,
Profit and loss account.
So, there is, you would not see any interest cost typically. There is some interest cost, but as a percentage of sales, it's very, very small.
Okay.
Right? Depreciation also will be very small because there's not that much capital employed.
Okay.
So interest and depreciation are extremely small. That is why you see that from EBITDA line 4,21,000 crores, if you go to the net profit line, more or less you get the same number. The only tax is the one that kills it. Okay, so from 4,22,000 you pay 98,000, you get to 3,23,000.
Okay.
But interest and depreciation are so small that you can almost ignore it in an IT company.
But why is that the employee cost is not accounted in this?
It's already put in COGS. They already put it in the COGS, cost of goods sold.
So that is how they are accounting in that. Okay.
Because employee is the cost.
Exactly. Exactly. Yeah.
So all the employee costs are allocated typically in IT company.
Okay.
It's all be allocated.
Okay.
So from a balance sheet perspective, you can see that their equity and reserves, that is total money raised from equity, is about, if you look at 8,41,000 crores.
Right.
And the debt is zero.
So it's a zero debt company.
Yeah. Zero debt company.
Phenomenal.
Because you produce so much cash, what do you need?
I see.
Debt.
I see.
In fact, actually, banks basically chase IT companies to give money
Okay.
because it's a very safe company to
Okay.
lend.
Yeah.
They don't need the money.
Yeah. So that is why there is not much a difference between EBITDA and the other
Yeah,
margin, that
no
because
interest
interest
cost,
payments
very
are not
low,
there.
very low, yeah, very
Okay. Yeah.
And again, you can see mostly it's receivables.
Yeah.
Most of the money is invested in receivables because you have to give.
Yeah.
So typically 40, 45 days of credit
Yeah.
will be there. So that's where most of your money is
Yeah.
locked up.
Yeah,
Other than
and-
that, there is nothing else.
Yeah.
Hardly anything. It's again another cash machine.
Okay.
Okay.
Yeah.
So you can see the.
Margins.
Did I have cash flow statement? No, I didn't show you cash flow.
Yeah.
Yeah. So again, you can look at the ratios.
Yeah.
So here in this case, the current ratio is 2.69.
That's way above what we talked about.
Because it's a IT industry is phenomenal.
Again, as we saw earlier, the ratios are organized in terms of margins, financials, as well as
so
investment.
you can see the gross profit margin is around 42%.
Okay.
EBITDA is around 27%.
Okay.
So those companies are 20s, right? This is 27.
Yeah.
And net profit margin is 20.6.
Okay.
So 20 to 25% profit margin, net profit margin is definitely possible in IT industry.
Right.
Though the companies which are growing very fast might have a slightly lower margin,
Yeah.
15 to 20%.
Okay.
But 20-25 is considered to be a good margin.
And zero inventory days.
No inventory. But you see the debtor days is 85. Which means these guys are giving nearly 3 months of credit to their customers.
Even that's not bad. So there is a,
But I think it's somewhat, many companies this debtor days has declined also.
Okay.
For TCS it doesn't seem to have declined.
Okay. And dividend payout percentage is quite high.
They pay out.
Good for a retail investor.
Not that much.
Okay.
If you look at their cash that they're generating, they don't give out that much dividend compared to the cash that they're generating. Yeah.
And these are the valuation ratios.
Huge valuations.
Yeah.
Right? So
earnings per share is quite high.
I did not capture the ROC, is it?
No, go back.
I think I did.
There is
okay,
this.
there is. Okay, return on AC, right? Return on adjusted capital. Right?
Yeah.
So that is like 40%. 39 to 40%.
Yeah.
And the reason why it's 39 to 40% is because TCS is sitting on hoards of cash.
Okay.
So they have so much of cash, they're not employing it in their business, they're not doing anything with it actually. It's just sitting.
Yeah.
Right? Well, IT companies are sitting on lots of cash because they want to prepare, they want to keep it, as they call it, dry powder.
Okay.
Dry gunpowder, right?
Yeah.
You're trying to keep it for waiting for opportunities for acquisition. Some consolidation may happen, you won't use it.
Okay.
So they keep it.
Yeah.
So because of that, the return on capital is lower.
Right.
If they kept only that much cash as is required for running their operation, it would be like Nestle.
Yeah.
120% ROC will be there.
Dividend yield is also quite high percentage.
Yeah.
And price earnings ratio is quite high.
The price earning ratio is around 35.
Yeah.
Because people expect now that TCS will grow at about 10 to 15%.
Okay.
That is why they're giving it a higher price earning ratio. Okay, I think that's about it. The rest of it are all some kind of operational charts.
Okay.
So you can see that revenue growth is starting to pick up.
Okay.
I think. So their costs are very well managed. TCS historically has been known as a company that manages cost.
Okay.
Extremely well manages cost.
Okay.
So compared to other people in the industry, so Accenture is an international company. Capgemini is European. Accenture is US.
Yeah.
Cognizant is Indian company but US.
Okay.
US headquartered.
Yeah.
These are Indian companies.
Yeah.
So you see that TCS is among the best costs managed, right? Well managed.
So cost per employee is, so we interpret it like this, 30,000 rupees is the, or whatever is the cost
dollar,
per,
I think,
dollar.
Per year.
Per year is the cost per employee.
Oh, total loaded cost.
Total
Take
loaded.
all the cost and load it on employees, number of employees.
Whereas for Accenture, it is, double.
Almost double, yeah.
Kind of a thing.
Yeah.
Okay.
And net profit margin has been hovering in this range for a long time.
Yeah.
and SG&A costs also are narrow band,
Okay.
well managed.
Okay.
And they have started subcontracting quite a lot. So you can see it was 6 odd percent, now it's now 7 odd percent. So
Okay.
they're kind of slowly increasing subcontracting.
Okay.
Even went to 8.
Yeah.
Industry, I think this industry will start looking at more and more at subcontracting.
Subcontracting.
By as a means, because they have a much better control over this aspect, which is this what is called total contract value.
Okay. Okay.
So this tells you the deal pipeline, how many
Okay.
contracts they're winning and so on.
Okay.
So the only way to get a view of what the future revenues of this company is going to be is in terms of looking at its order book.
Okay.
Just like any project management company, like L&T also, you would do the same thing. So you would basically look at how much contracts they won. So that looks, the deal pipeline looks good. So you can see that they're winning many more deals.
Okay.
So bigger deals,
Yeah. So this is the total contract value.
total contract value.
So
Contracted deals, all their contracts that they've written with customers.
okay.
Value
so
of
so this is, for example, this 6.8. I would interpret it as now in the last quarter, that is 3Q of 21, TCS had got into contract of 6.8 US billion dollars. Okay. So that's a kind of an assured income for them, no? Because you have already contracted.
So if you take this 4 quarters and you add it up, you will get some idea of next 4 quarter revenue.
Yes.
Some idea you will get.
Okay. That's a very interesting kind of a, yeah.
Yeah. And usually these contracts are, many of them are long term.
Yeah. Whereas in manufacturing, you can't do this because you don't know what is going to be the demand kind of a thing. No?
The demand is
here
very
you are having upfront
symmetric.
contract because it is a services kind of
correct,
thing.
correct.
Okay.
Yeah.
So they're very.
But manufacturing services or engineering contracting companies,
That's a different.
that is different.
Okay.
So if you're building roads, for example,
Yeah.
like L&T is
Yeah.
doing metro,
Yeah.
rail, or doing roads or something like that.
Yeah.
So there also you can do this contract value.
Yeah. Construction companies.
Construction companies or BHEL, power equipment,
Yeah.
things like that.
Okay.
Attrition has come down, but if you prolong it, now you look at the new picture, it's gone up again.
Oh.
Yeah.
Okay.
But it's kind of came down during the COVID time, attrition.
Okay.
Historically around 11-12%.
11-12%. So the industry.
Now it's gone back to 11-12 and probably.
The industry average is close to 10%?
No, the smaller companies have attrition
Higher.
Much higher.
Okay.
Much higher.
Okay.
Bigger companies have lower attrition because they are sitting on a much bigger pool.
Oh. Okay.
Yeah. It's not possible for so many people to leave the company. Where do they go?
Yeah.
So that's the thing. So DSO days has improved, as I explained, right? During the pandemic, it was 72. Of course, we saw some 80, I don't know, something. This is a different chart, I think.
DSO means what, JV?
DSO is days of sales.
Okay.
Outstanding, which basically means how many debtor days.
Yeah, debtor days. Yeah.
But there we saw some 88 days. I don't know, this seems to be a different company.
Yeah.
But analyst.
Yeah.
But generally, the DSO has declined. That's what it shows.
Okay. Right.
I think. Now, I want to just show you this last chart.
Yeah.
And we will see it more when we see the industry trends.
Okay.
But this shows basically what the billing rate is. Billing rate is usually IT is billed in per hour rates.
Okay.
Like consulting and lawyers and all that, right?
Right.
So they bill in hours.
Yeah.
So business analyst in the United States charges $110 to $205 an hour.
Okay.
Whereas in Asia, which includes India,
Yeah.
it's only $30 to $40.
Oh my
So
God.
we still have what is called a cost arbitrage, right?
Yes.
So for you take a QA guy, for example, right? Junior QA is quality analysis.
Okay.
It's testing basically.
Yeah.
$80 you're spending roughly in US, whereas you will only spend $15 to $20 in India. So it's,
Okay.
you will see a 3 to 4 times difference between US rates and Indian rates. So that steep decline in rates will push business to India, offshoring as it's called.
Yeah.
You will see this offshoring trend primarily because there's a change in the billing rates.
Okay.
So from here to here, from here to here. So Eastern Europe is another place which is also competitive, but still it is about 50% you can see more than India.
Yeah. Yeah.
So some people do work in Eastern Europe, but they can also come to India.
Yeah.
Depending on talent.
I see.
So this will keep us going another 10 years. We have easily just on cost arbitrage.
I see. So if we are to name some countries, GV, in Latin America, what could be the countries who are into IT?
Not very big. Mexico, for example.
Mexico.
And again, you will find Indian companies with operations there.
Okay.
Indian companies have set up things in Brazil. TCS has operations in many countries, including Brazil, Mexico and all that.
Okay.
Yeah. So they operate
And
from there.
Eastern Europe, what are the countries like?
Eastern Europe, you have Belarus, you have Minsk,
Okay.
for example, is one city where you have a lot of things.
Okay.
You have Ukraine,
Poland.
Poland.
Okay.
Poland is a bit expensive.
Okay.
Yeah, but Latvia, all this. I mean, the problem in Eastern Europe is that you can't find enough people.
Okay.
You can set up a center for 200, 300 people, but if you want to do a much larger operation, it's
You
difficult.
can scale it up to.
But the quality of people is quite good.
Okay.
They are quite good.
Okay. So this is good. This is the kind of a driving force in terms of the growth of industry in India, in terms of this cost advantage that we
Cost
have.
advantage, yeah.
Number
Significant
one.
cost advantage.
Number two, a large pool of resources that is available in India in terms of workforce.
Yeah, yeah.
Okay. Yeah. Yeah. So I think this is very interesting kind of an engagement with numbers, because in the earlier discussions what we had is just to show the dry ratios, and now we are able to draw some inferences using those ratios when we use numbers.
Yeah.
So if we are to draw some inferences, one, there is wide inter-industry variations in terms of profits and
Profit margins, yeah.
profit margins. And it is a function of the type of industry,
Yeah.
which is also related to the kind of quantum of capital and the type of capital that gets employed. And that is where our analysis of costs into fixed costs, variable costs and things of that sort become very relevant. Second thing that I could actually understand from this is that we use this concept of economic costs and accounting costs. Now we find that the accounting costs is giving us very detailed breakup in terms of costs. And then once when you use accounting costs, then perhaps you get the finer aspects of costs involved in terms of production as well as sales of goods. Yeah. Now the third thing is very, very interesting, that depending on the type of industry, labor costs vary. And that gives us an idea whether the production, remember we talked about the production function.
Yeah.
And production function captures this relationship between inputs and outputs. No?
Right.
So looking at this labor cost, we can infer something about the underlying technology of production as well as the production function. And we find that, certain industries like textiles, it is more labor intensive, whereas cement and other industries are capital intensive. So depending on that, we find that the costs are also varying. Fourth interesting kind of an inference which I could draw, GV, is the kind of capacity utilization variations one could have in terms of demand. For example, in cement, we find that there is very high upfront capacity installed. And according to seasonal variations, you can use that capacity over time. Whereas in textiles, the basic labor intensive operations, you will have to hire people immediately and then expand depending on. But in textiles, what they do is to adjust for this capacity or seasonal variations in demand, they stock inventories more and release these inventories into market as and when there is seasonal variation kind of a thing. And finally, we saw very important and the bottom line in terms of return on capital employed. Ultimately for any investor, whether it is an entrepreneur or whether it is a retail investor, the bottom line is in terms of the return on capital employed, and we find variations across industries, across firms on return on capital employed, and how they are improving the return on capital employed over time in terms of cost reductions. Yeah. So I think then,
and how they use the cash is the other thing.
How they use the cash to.
Some are giving it back.
Some are giving it back.
Some are plowing it into the business. Cement is plowing it back. We saw that. Some are using it to reduce debt.
Reduce debt, so that interest payments in the next time period is actually reduced, kind of a thing.
Yeah.
So I think all of this actually sums up our analysis in terms of profits and profitability as well as costs. Now in the next step, what we shall do is to move from a firm level analysis to an industry level analysis, so that we can have a broader macro kind of a perspective.